Welcome back. I'm Dr. Ish, former banker and finance strategist. And on this channel, I break down how money really works across the world, UK, United States, and of course, Nigeria. And today's episode is about recession-proof investments. Recessions isn't just a deadline, it affects jobs, it affects savings, it affects currencies, and the value of your investments. And over the years, I have seen two types of investors: those who panic when the economy slows, and those who are positioned ahead of time. So, in this breakdown, I will show you assets that historically hold value, generate stability, or recover faster during economic downturns based on how each region works. Now, this is not financial advice or a get rich quick guide. It is simply education. So you can make smarter and wiser financial decisions. And we'll be starting with what actually makes an investment recession resistant. So you're welcome today. And of course, as usual, feel free to drop your comments and your questions for me in the comment section. So what makes an investment recession proof? This is a very, very crucial and important question, because the truth is not every investment can survive recession. Not every investment can actually survive recession. So this is a question that you need to wisely ask yourself. So the first quality is essential demand. These are goods or services people need regardless of economic conditions, which are food, utilities, shelter, and basic health care. Second is real asset backing. So assets tied to something tangible like land, commodities, infrastructure tend to hold value better than purely speculative paper assets. Third is low correlation to market panic. So when stock markets swing wildly, some assets move differently or better still remain stable. So you need something that has a high level of stability. You don't want to be having high blood pressure every other day. And finally, inflation resistance. So during recessions, governments often print money, which are, of course, assets that protect purchasing power matter. But with this framework, it will look at how this plays out region by region. Of course, these regions that I'll be analyzing basically are US and Nigeria. We'll be starting with the UK. Now, in the UK, recession-resistant investing often focuses on defensive assets. So one major option is gold ETFs, such as physically backed gold funds, because gold has historically acted as a store of value during uncertainty. So next are REITs, e.g. UK Commercial Property Trust. So if you're living in the UK, you need to do some research on this. I highly recommend, because it's not basically about speculative development. These generate income through rent rather than price speculation. Now we also have the dividend paying stocks in essential industries like utilities and consumer staples. They also perform relatively well in downturns. And finally, we have essential services, ETFs, which spread risk across healthcare, utilities, and infrastructure companies. So in the UK, recession strategy is about income stability and asset backing, and not necessarily aggressive growth. So moving to the US, like I always say, these are the basics. You need to do your own in-depth research. This is just me opening your eyes to the options that you may not be aware are available, or you are aware are available. You're not really sure of how safe in terms of risk answerability, sustainability, and scalability they are. So this is me sharing the basics with you. However, as a financial strategist and advisor, I always say make sure you do your own personal research because not all investments are meant for you. You need to find that which aligns basically with your level of risk appetite. But then information is out there for you to gather. You just need to take your time and be patient. But in all my finance, I never advise quick rich schemes. I don't preach crypto and some of the rest because they have a very high risk value. Now, I'm not saying that there's no business that does not have risk, but I'm opening your eyes and your knowledge to other aspects you may or may not have explored. So now moving to the US, um, consumer staple stocks companies selling everyday necessities tend to remain stable because demand doesn't disappear. You don't need to even research so much on it. It's just the truth. Consumer staples hardly ever had. I mean, looking at Walmart, P&G, and the likes. So we also see that in similarity to the UK, gold and silver ETFs are commonly used as hedges against inflation and currency risk. We also have energy stocks, especially large established producers, which often hold up better than growth stocks during downturns because there will always be downturns. That's it. You have no control over these. And energy demand remains essential to livelihood. Another very unique US option is farmland investing through regulated platforms. Regulated platforms. Take care. So food demand is constant and farmland has historically appreciated independently of stock market cycles. And in the US, diversification and scale help to protect portfolios. Like I always say, do your research. This is just me opening your eyes to the options readily available. Now, coming to Nigeria, where the value stays, Nigeria operates differently and recession-proof strategies must reflect local realities, which is why in some ways, some things that may work in the US and UK may not necessarily work in Nigeria. Some things that work in Nigeria may not work in the US and UK. But if you have global reach in any of the three countries, you can explore each of the options in each of the clients. Now, for Nigeria, farmland investments remain strong because food demand never stops, regardless of economic conditions. The palm oil trade, which I'm so passionate about, and storage business benefits from supply gaps and timing rather than consumer spending patterns. Of course, we have real estate in strategic areas such as student towns or border regions. They tend to retain rental demand even during downturns. That is simply you having houses, depending on your financial capacity, where there are universities and of course border regions. Rent usually does invariably well there. We're not talking about making millions at once. Remember, I always preach long-term wealth building. Now we also have gold savings products. When properly structured, they offer protection against currency depreciation. And in Nigeria, recession-proof investing is often about preserving value rather than chasing returns. I'm sure this is something, if you are living in Nigeria, you clearly understand what I'm trying to talk about. Now, recession proof, risk free. This is important to understand. Recession proof does not mean risk free. There is no business that is free of risk. Stable assets often come with slower returns. So if you are the type that you want quick returns, then this video may not be for you. Liquidity matters. So how fast you can access your money if needed is something you also need to consider before going into any business. Fees also matter. High costs can quietly erode gains. These are things you need to look into. Stability, liquidity, and fee. And of course, asset backing also matters. Always understand what actually supports the investment. So the goal during recession is capital protection first. That is, whatever amount of money you put in, you should be sure you will, if you don't even get any gain, you should be sure that you can get that particular money back before you now talk about growth and scalability. And that is why diversification across 2 or 3 asset classes is critical, meaning do not put all your eggs in one basket, no matter how mouth-watering it may look to you at the moment. Now, when economic uncertainty rises, I personally like to think in layers. Roughly 40% in stable assets such as gold, farmland, or income generating property. I personally do farmland. Some people are strong enough to do gold. I'm not as strong, but of course, this is just me saying my own personal, but I highly recommend gold, REITs, and of course, farmland. And then about 30% in growth opportunities, carefully selected. And now, when I mean carefully selected, I'm not talking about building on speculation. Speculation does not help you grow in business. You will get burnt if you invest based on maybe, maybe not. You need facts and figures backing over time. Now another 30% in flexible cash or high quality savings ready to deploy when opportunities appear. This approach creates stability and optionality and of course peace of mind. Remember, all your eggs should not be in one basket. Diversify across, different asset classes. So the goal is not to predict recession. We are not praying for terrible things to happen, but it's to be prepared in the long term. You have no control over economy, you have no control over the government, and even if you do, you still need to prepare because as the saying goes, if you fail to plan, it also means that you are planning to fail. And my final takeaway, as usual, is you cannot control the economy. I keep reiterating on this, but you can control how exposed you are to risk. And as usual, I have put together a recession-proof investment checklist. So if you need it, you can always drop the comments for me in the comment section, and any other aspect of investment, finance, making money, starting a business that you think you need me to also explain to you in basic terms, I would appreciate a feedback from you. As usual, I entertain comments and I always respond. And if you enjoyed this breakdown, if you learned something new, or there's any aspect of it that probably is not 100% clear to you, I am available to break it down to you further, or better still, do another video centralized on one particular one if you need that explained. And of course, don't forget to like, share, and subscribe. And I will be seeing you in the next video.